Despite the widely predicted by almost all economists a global recession in 2023, the world economy has displayed unexpected resilience with a global GDP growth of about 3%. This resilience is further underscored by data from reputable sources such as Goldman Sachs and the OECD, which highlight ongoing economic activity at levels comparable to year 2019. Indicators such as weekly GDP and Purchasing Manager Index data also paint a picture of robust economic performance across various sectors and regions. The prevailing concerns about the financial system echo the multifaceted challenges facing economies worldwide. Bond markets, crucial for financing government debt and corporate investments, are under scrutiny amid fluctuations in yields and investor sentiment. Commercial property markets, sensitive to economic cycles and consumer demand, face uncertainties regarding occupancy rates and valuation trends. The health of banks, pivotal for financial intermediation and credit provision, is closely monitored amid evolving regulatory landscapes and digital disruptions. The resilience of labor markets stands out as a pillar supporting economic stability and household well-being. Across the OECD, low unemployment rates below 5% demonstrate the robustness of labor markets, signaling opportunities for employment and income generation. Monthly non-farm payroll grows by an astounding 350,000 jobs or so. The high employment-to-population ratio further underscores the positive labor market dynamics, highlighting the availability of jobs and workforce participation. This strength in labor markets plays a crucial role in mitigating the impact of inflation on real household disposable incomes, providing a buffer against cost-of-living pressures. The impact of higher borrowing costs has been alleviated due to a considerable portion of household and corporate debt being structured with fixed interest rates. Rich world consumer confidence, after reaching its lowest point in 2022, has experienced a significant surge. But it's not a victory yet, as increased interest rates could potentially result in a delayed effect on economic growth. Inflation figures, which soared to peaks of about 8%, have moderated to about 4% but remain elevated, posing challenges for central banks tasked with maintaining price stability. Central banks have responded proactively to these inflation dynamics, implementing measures to manage interest rates and monetary conditions. Interest rate adjustments, aimed at curbing inflationary pressures, have been a focal point of central bank strategies. However, the effectiveness of these measures in achieving inflation targets has been tested by ongoing economic uncertainties and external shocks, such as increasing fuel prices and supply chain disruption in key choke points of the world like the Red Sea. Post-pandemic, the public's awareness of inflation risks has heightened, as reflected in surveys indicating higher long-run inflation expectations. This shift in perception has implications for consumer behavior, investment decisions, and market sentiments. Investors and market participants have responded by seeking increased charges for long-term inflation protection in financial markets, signaling concerns and doubts about central banks' credibility in managing inflationary risks. Central banks face a dilemma in balancing inflation management with economic growth objectives, particularly in regions like Europe and America, where central banks were originally too slow to hike interest rates. The need for agile policymaking has become paramount, necessitating quicker adjustments to interest rates and a tolerance for economic volatility. One thing is clear for many economists: it is unlikely that the 2% goal will be met given the current pace of economic growth, which is partly driven by an unsustainable government deficit. The world economy's current state reflects a delicate balance between inflationary pressures, central bank responses, and market dynamics. Central banks' challenges in managing inflation while supporting economic growth underscore the complexities of modern monetary policy. Adaptive policymaking and a nuanced understanding of market reactions will be crucial in navigating future uncertainties and maintaining economic stability. Looking ahead, central banks must continue to evolve their strategies, embrace flexibility, and foster transparency to effectively manage inflation and ensure sustainable economic growth in a dynamic global environment.